Hi, welcome to the week that was, where we break down all the big events from the week and tell you how it impacts your money. As usual, starting off with the markets. I'm wearing those colors that reflect the market sentiment. October has been a tough month. September was great with a lot of positive cues. However, October has undone all the good work the markets had done over the last 3 months. Nifty 50 and Sensex, which are the two big indices in India, have corrected over 8% from its peak. However, year to date, both these indices are up 11%, which isn't a bad thing. We've been discussing about the triggers for this tumble, foreign investors and corporate earnings. Foreign investors hit a new record by withdrawing over $10 billion from India. This has led to the rupee to slide further and hit a new low. This monthly withdrawal surpasses the 66,000 crores that they had withdrawn in the month of March 2020 at the onset of COVID-19. But on a positive side, foreign investors continue to hold about 16.3% of the Indian equity, which is in fact higher than what it was in the month of July. So foreign investors' money does come in and get out very quickly, as you've realized. Moving on, crude prices are staying steady in spite of tensions escalating in the Middle East. Gold prices have hit an all-time high again. 1 gram of gold today in India cost about 8,070 rupees. Rupee, as we mentioned earlier, has hit an all-time low and has comfortably breached the 84 rupee mark. The second trigger for the market has been earnings. The corporate earnings so far has been underwhelming, with majority of the companies declaring single-digit growth in revenue and net profit. Of all the large companies that have announced results, the average revenue growth has been 7.2% and the average net profit growth has been 2.5%, which is a 6-quarter low. The bright spot has been financials, which includes banks that have declared an average revenue growth of 14% and net profit growth of 15%. IT earnings have been mixed bag, but auto, consumption and cement companies have struggled. I'd like to focus a little bit more on the earnings of HUL or Hindustan Unilever for two reasons. One, they're a dominant player in the consumer space, which includes your beauty care, personal care, home care, food and beverages. Two, they capture the sentiment of both the urban area and rural area. HUL declared a revenue growth of 2%. However, their net profit fell by 3%, falling short of market expectations. The stock price fell over 6% in a single day, which is a very unlikely event for a company of this size. The CEO, Rohit Awa, did raise concern about the slowing demand in the urban areas. However, he did mention that the rural area is seeing a recovery. The earnings and the reaction to earnings captures the current sentiments. Expectations are very high. The actual growth is at best modest. With single-digit company growth, expecting extraordinary returns from the market is unrealistic. Ultimately, the company growth decides share market returns. As an investor, you should be aware of the fact that these ups and downs are part of the market cycle. Staying invested for the longer term and tweaking your portfolio based on macro trends will help you navigate these waves better. Moving on to the stories of the week, I've got two of them for you. First, US markets and its earnings. While Indian markets are struggling, US markets are surging. The two popular indices, S&P 500 and the tech-heavy Nasdaq 100, have gained over 3% this month and continue to hit all-time highs. The key driver has been Federal Reserve's decision to cut interest rates that have fueled the market momentum. When the interest rates fall, the cost of borrowing drops for both individuals and corporates. This results in more borrowing, more home purchases, more business expansion, ultimately resulting in greater demand and greater growth. Unlike in India, the corporate earnings in the US has been robust as well. 76% of the companies that have reported earnings have beaten market expectation. One star performer is Tesla, whose share prices were up 14%. Unlike in India, the expectations in the US are lower and the companies are able to beat those expectations comfortably. This highlights the importance of diversification. As an investor, you need to look beyond Indian markets to reduce your risk and potentially increase your returns. If you're struggling to diversify globally, do reach out to us and we would be happy to help you with your portfolio and asset allocation.
My second story is from a meeting that occurred at the BRICS Summit hosted by Russia. 5 years after the Galwan border clashes, Prime Minister Narendra Modi and Chinese President Xi Jinping met up at the BRICS Summit in Russia. This meeting was of great significance for both parties. India was able to secure a border agreement as per which the troops will be withdrawn from the border areas. This would definitely help India so that we can focus on more pressing matters. However, we have to still keep an eye out based on past experiences. Between 2014 and 2019, the two leaders met up at least 18 times, and yet these clashes occurred.
But the landscape has changed. The Chinese economy is slowing and facing challenges such as overcapacity, US tariffs, and Europe trade restrictions. On the other hand, India's standing is rising, and it's evident from our deepening relationships with US, Japan, and the West in the areas of defense, raw materials, and manufacturing. Historically, Russia has been supportive of both India and China. China at this point does not want to increase their friction with India and in fact might want to slow our collaborations with the West. From an Indian perspective, we are in a very enviable position with most global powers wanting to engage with us. The key is to maintaining our neutrality and our strategic autonomy while balancing our needs and not alienating the West or the BRICS partners. With that, we come to the end of this show. Do like, subscribe, and share. See you next week.